Today we're going to be looking at a maximum potential calculator. This calculator will assist us in looking at the amount of money that could be passing through your hands over a 30-year time frame. In this particular calculator, we're going to show this individual earning an annual income of $150,000. And we're going to show this $150,000 having an inflation rider and or an increase of 4%, assuming that this individual's business or practice is going to continue to grow over these 30 years. If you notice, that takes the number to 8.4 million, meaning $8.4 million will be passing through this person's hand over a 30-year working time frame. Now suppose you could take every penny of the 8.4 million and invest it, earning a 5% rate of return. Now we know that isn't possible, but if you could, that money would grow to 16.9 million. The reason it isn't possible to invest every penny, obviously because we have expenses, we have eroding factors that take away from the money that we're able to hold on to, and cost of living and lifestyle. So let's look at some of these eroding factors of this 16.9 million that you have the potential to earn over a 30-year time frame. The number one eroding factor is taxes. National average for taxes is 40%, or 40 cents out of every dollar. You notice it takes the 16.9 million down to 10.1 million. Now we're not talking about just federal or state income tax, but we're also talking about property tax, gasoline tax, sales tax, cell phone tax, all these different taxes we pay, and we probably could argue that it's much more than 40%. But for sake of this calculator today, that's what we're using. Debt service. This is mortgage interest, credit card interest, student loan interest and payments, all these things we have debt for. National average, again, is 35%, or 35 cents out of every dollar. Eroding the 16.9 million down to 4.2 million. Now this is your money. This is money that's passing through your hands. And lastly, we want to look at lifestyle at an average of 23.5%. Now at the end of this 30-year time frame, you had nearly 17 million pass through your hands with a savings now of 254,000. Now I don't know about you, but I've heard other people say, I make all this money, where does it all go? Well, here's your answer, or at least one of your answers. Taxes, debt, and lifestyle, major eroding factors. So 254,000 at the end of a 30-year time frame. Most Americans aren't getting by with their current financial plan. We find that 401ks, IRAs, and the typical financial planning, it doesn't work. Speaking of typical financial planning, what you'll hear from most financial planners is, look, the reason you only have 254,000 left at the end of a 30-year time frame in savings is because you only earned a 5% rate of return. They tell us to take more risk on our money, and by taking more risk, we're going to earn a higher rate of return. So let's look at that. Let's take the earnings rate to 10% and look at what that does at our savings. So instead of 254,000, we now have savings after 30 years of 585,000. Not very dramatic, and quite frankly, it's not the answer to the problem. Taking more risk on our money, turning it over to financial planners that are going to invest it in the market, it's not the answer. And you're listening to this probably because you recognize that that advice you've been given isn't the answer. So we're going to bring this earnings rate back down to 5% and talk about a few things that you actually have more control of. So let's look at taxes. What if you were able to reduce taxes through either corporations, a more aggressive CPA or accounting, keeping books straight, owning a business, a number of different things you could do to lower taxes. But what if you could lower taxes by 10%? Not from 40 to 30%, but 4%, which would be 10% of 40. So let's drop this down to 36%, and notice what happens to this net savings rate by making this one small move. Now there's $934,000 in savings, a much more dramatic increase by reducing taxes than there was by taking more risk on your money, trying to earn a higher rate of return. Let's look at reducing debt. Now, many Americans are in debt today, and it took a number of years to get in debt, so this may happen over a longer period of time. But let's say you could hypothetically reduce your debt or cut it in half over the next 3, 5, 7, or 10 years, and take the 35% debt down to 18%. Watch what happens to the savings number. A significant increase to $3.8 million. Now notice we didn't reduce the debt down to 0 because there is productive debt. But getting rid of unnecessary debt or continuing to pay down debt over time significantly increases the amount of money that we're able to hold on to, $3.8 million. We're not going to touch lifestyle at 23.5%. We're going to leave that exactly where it's at. But what this calculator assists us in looking at is, number one, the amount of money that you have the potential of earning throughout your lifetime. Number two, the eroding factors that take away from that money. And then number three, what you can do about holding on to more of that money. And that's the idea. That's what we assist you with here at Optic Financial, is teaching you and educating you on how to hold on to more of the money that is passing through your hands. Rather than relinquishing control, we're going to assist you in keeping control. For this and other strategies to optimize your wealth, please visit us at wealthoptimize.com.